How much do interest rates really matter when you're looking to buy a home? Well, join me, Brittany, with Brittany Hannon Real Estate. I'm a real estate agent, coach, and investor, and one of my favorite mortgage advisors, Anai Rivera, as we talk about just that. There are some big things that you need to know, so let's dive in and talk about it now. All right, so jumping in, interest rates for the last year, this is like the last quarter since September of 2023, they've been hovering in the sevens, and now they've started coming down to like the mid sixes. So they were getting up like in late 2023. Well, I guess in October, this says October, November 2023, it was in the high sevens. So where are we at today with interest rates?
Yeah, so that's a great question. So in terms of FHA, so there are different kinds of loan programs that we usually go for first-time home buyers. But right now, the lowest rate I've seen is actually a 5.875, which is on an FHA loan. So that is amazing news just because we are starting to see, interest rates drop again. So as of October of 2023, rates were at their highest they've ever been. They were actually at their 8%. So now we're slowly starting to see, interest rates dropping. Like I said, as a broker, I do have access to different companies. So not everybody's going to be able to offer this 5.875, but most people, always go based on the average. So depending on our credit score, then we can definitely try to get that rate. So we are going to continue seeing a decline in interest rates. And I'm so excited for that because that's going to allow more families to come into the market and be able to purchase a home.
Absolutely. I love to hear that.
Mhm.
So what did you say? 5.5%? No,
Yeah, 5 3/4. So
five
5.75 to
5.75. That's really low. Okay,
Mhm.
but realistically, who would be the person? Like, who's the avatar who qualifies for that?
So it would be somebody that has great credit. So somebody over the 700 credit score, somebody that, is currently employed that is going to be able to show income for the last 2 years. So pretty much it goes based on credit score. We want to make sure that our credit is strong because that will determine what rate we get. So that would be like the ideal candidate.
Okay, and what kind of down payment do they have to put down?
They actually just have to come in with as little as 3.5%.
And I love that you're saying that because so many people have the misconception that they have to come in with 20%, right? And
Yeah.
20% for so many people, especially in our market where, our average price point is around 800, 900,000. So
Mhm.
20% of that is this astronomical number that most people don't have that sitting around in their bank account. But 3.5%, now we're starting to talk about a more realistic number. So is that 3.5%? Is that accessible to everybody? Can everybody put down 3.5%, or is that just for special buyers?
Yeah, so it would be anybody that currently does not have an FHA loan. So we can only utilize this FHA loan once, meaning you cannot have had it in the past or currently have it on your property. You can only use it once, like I said. So 3.5% would be for anybody that's going into the market that's brand new. In case you don't fit those specific requirements, and we can always look into doing a conventional loan where you actually just need 5%. So no matter whether you're a first-time buyer or not, you can actually take advantage of coming in with as little as 5% down, even if you are purchasing another home.
Okay, so still 20% is not the number that everybody has to shoot for. Now, of course, the reason that a lot of people say that 20% is because once you hit that 20% loan to value or 80% loan to value, that's when the PMI or the mortgage insurance falls off or you're eligible to get it removed. So that's where that 20%, that magical 20% number comes in. That's what everybody's talking about. All
Mhm.
right, let's keep it going. Okay, so this is an image that I always love to talk about. So, what we have here, what this graph shows is this graph shows the interest rate over time. And it shows, of course, in like the 80s and 90s, the interest rates were like way up here. And people always talk about, I remember when the interest rates were 18%. You're like, okay, grandma. But the reality is that interest rates were a lot higher. And
Mhm.
interest rates have come down and they went down to like 2%, which we realistically are not going to see again.
Mm-mm.
We saw that because of a worldwide pandemic. We are not going to see that again. And if we do, it's going to be because of some kind of like catastrophe like that. And so we don't want to see that again. It was great for the people who were able to take advantage of it, but it's not likely going to happen anytime soon. So when we look at these prices, though, what we fail to remember is that as these interest rates drop and go down, appreciation and home values just go up and up and up and up and up. For the most part, they have a steady incline. Now, here we see a dip. This dip was in 2008. So everybody talks about, oh, the fall of 2008. But look at how much higher we've come since then. And I mean, if you took this goes to 2020, if we took up into 2023, we'd be like way up here. And so what I love about this picture is this picture shows the rate volatility is this guy with the yo-yo. The yo-yo is the rate volatility. It's going up and down. And then the housing appreciation is that guy walking up the stairs. And so the yo-yo, he is using that yo-yo to go up and down. So that is volatile going up and down, but he is consistently walking up the stairs. And so what happens is that he's walking up the stairs. And so even if at some point something happens to where the housing prices slow down, maybe he's not running up the stairs anymore. Maybe he's just slowly walking up the stairs. But almost never is he going to turn around and fall down the stairs and go completely backwards. He's always going to keep going up those stairs. And so even with this yo-yo and the rate volatility, at some point when he buys his house, that yo-yo is going to stop. It's going to freeze where it is, and he's going to keep walking up the stairs. His housing appreciation is, or her, is going to keep going up. And so we want to keep that in mind, because I think that this is a really great visual to just remember that your house is your largest asset a lot of the time. And so if you are just always focused on interest rates, you're missing the bigger picture. The bigger picture is that you have this asset that is increasing over time. So we talk about it's not about timing the market, it's about time in the market. Yeah. So we want to make sure that we're not timing the market. So stop trying to time the market. Not only is it a waste of time, but even for the experts, the probability of failure is high. And if you followed the experts over the last 3-4 years, you know that they talk about, I mean, they've been wrong 150 times over the last 4 years. And so you really don't need to you don't have to listen to what the experts are saying. You have to look at, like, what is my situation? What do I need today? I just did a video and it was talking about like the top 5 reasons to move, and not a single one of them was about interest rates. Not a single one of them had anything to do with that, because it's not about the interest rates. Yes, you're making a financial decision, but the bigger picture is your house appreciation is going to go up. So
yeah. And actually, to add to that, we actually are seeing that every year for the past 3-4 years, homes have appreciated significantly by at least 5%. So we're going to continue seeing that as we progress through the years. So it's not like you're going to be upside down on your home. That was way back. You know, it never really happened based on the graph. A lot of people were saying 2008, my house went from X to Y, but not anymore. Honestly, a lot of people are seeing the value that it brings, not only like generational wealth, but also for you, you know, it's kind of like a piggy bank. You're adding money into your home. Eventually, if you want to sell your home, you already have that equity that you could carry either to another home, or maybe, you know, do a cash out and just go to another state. I've seen a lot of people do that. So it's definitely an investment that you want to, you know, be able to obtain as soon as possible before it keeps on increasing.
Yeah, absolutely. Because not only your housing appreciation is increasing, but the cost of rent is increasing, the cost of living is increasing, everything's going up. And so at some point, it's going to make it so that it's totally unaffordable to live where you want to live. And so
Mhm.
you have to get in and you have to buy at some point to maintain that standard of living, to maintain those costs. But, I love that you brought up 2008 because we talk about this. And I feel like at this point, it was so long ago that a lot of people forget. And so, just a reminder, the whole reason that 2008 happened was because of bad lending practices that are not practiced anymore. So it was because they would give an 80% mortgage and then they would give another mortgage of 20% for the entire down payment, so that 100% of the house was financed. And then we, on top of that, had a foreclosure crisis because we had all of these homes that had balloon payments on them. And so those balloon payments were all of a sudden getting called due. And when they couldn't be paid off, the banks were failing. And then the banks were trying to foreclose, and all of these houses were now pushing all of the markets down in value. We're not seeing a housing crisis anywhere near that at all now. Nothing like that is happening. In
Yeah.
fact, 90, I mean, it's like something, there's some statistic and I can't remember what it is, but it's some high number, like 85% of people owe um owe less than 50% on their mortgage. It's some like ridiculous number. I can't remember what it is, but
Yeah.
it would be better if I knew that.
And you know what? That's actually true that you mentioned that because it like back then, like you were saying, it was bad lending practices. So people would literally come to loan officers and say, "Hey, you know what? I made $200,000," but it was stated income. So there was no form of really diving into people's financials and making sure that they can afford those payments. So that's part of the reason why a lot of people, lost their homes, unfortunately. So,
Mhm.
fast forward to now, 2023, we go through the entire process. We check income, we check debt, we check savings, we check credit. We want to make sure that these buyers that are now acquiring their homes can actually afford it to make sure they are not losing their homes. So
Yeah.
it's definitely been, a change in the lending industry as well for the better, yeah, a lot of people say like, no, there's so many requirements, but it's definitely benefiting all those who want to, buy because we do an in-depth review to make sure you're able to qualify.
Yeah. Well, when you're talking about buying this huge asset, it makes sense to be able to do that. And I think, that's one of the things too, is that that once you have a home, you generally know that you can afford to stay there unless something dramatic happens. You lose your job or something like that. And so, and even if that happens, one of the reasons why a lot of people are talking about, oh, foreclosures are coming. And the reality is, foreclosures are not coming, at
Mhm.
least not in the way we saw before,
Yeah.
because all of those people who might be facing foreclosure have a ton of equity in their homes. And so they can sell their home a traditional way and do exactly what you said. They can cash out and move to a less expensive area. They can go out of state. They can do something different. They have options where before they didn't have any options. It was just foreclose or get out.
Mhm.
So it's definitely a whole different scenario at this point. Okay, so this graph just kind of shows us what the averages have been. Just another visual to kind of show us what this was. So again, this is like back in the 80s where interest rates were 16. This is 16% on average for the year. It actually topped out at like 18%. So on average, across the board, this ends at 2022. But across the board, the average was 7.81. Now, what's the average for today for like an FHA loan?
Yeah, anywhere between a 5.875 to 6.5. That's the
Yeah.
range I've been seeing.
So we're still lower than what we're seeing here at 7.81 is the average across 40 years. So it is good to see that we're still lower than the average. Now, what we do know is that buyers come out in droves when we hit about that 5.5% mark. So
Mm.
at that 5.5% mark, that's when we start seeing lots and lots of buyers come to the market. And what happens when lots of buyers come? It's supply and demand, right?
Mhm.
It drives the prices way up. We're already seeing that. We're already seeing, like, right before we started this on IE, you were telling me that you're super busy because a lot of buyers are starting to come out of the woodworks now and starting to say, okay, this is the year that we want to buy, right?
Yes, exactly. And I feel like that's been, like a common thing. A lot of people were waiting for those rates to drop. But in the contrary, you should actually buy when interest rates are a little higher because it actually reduces the amount of competition out in the market. So you definitely want to make sure that, even though if you are able to afford it with the higher interest rate, just bite the bullet for a few months and refinance like a lot of people have been doing. So I kid you not, a few months ago, 6 months, 7 months ago, we came across a few clients at open houses and we would notice that, they were getting high payments because of the rates. But fast forward to 6 months later now, we are seeing people now take advantage. They got the home, they got a good price on the home. They even got some seller concessions to buy down the rate or even to cover their closing costs. And now they're able to take advantage of the rates dropping. So they secure the home and ultimately now they are going to refinance. So that is a potential thing, that a lot of people probably didn't think they could do, that they could refinance sooner rather than later. You don't have to wait for forever to refinance. You can actually do it in as little as 7 payments after your loan is already originated. So it is something that now rates are dropping, now more people are coming into the market. So it is going to create a little bit more competition because we have been seeing, there's not a lot of homes on the market, unfortunately. So we definitely want to make sure that anybody that is truly interested that reaches out to us to just set a plan of action for them and make sure that they're able to afford a home soon.
Yeah, absolutely. And I think that I love what you're saying about that because that lines up exactly to what really what we'll talk about later is when we see lots of buyers coming to the market, it's going to drive those prices up. And right now, we're starting to see more buyers coming to the market, which is starting to drive those prices up. And so, what we're telling people is if they're ready to buy, now's the time to buy because it's better to buy now and then be able to refinance than have to pay $200,000 over asking in 6 months
Mhm.
and be potentially priced out of the area that you want to be. Well, I hope that helped. Reach out to me or on IE anytime. Here are our numbers. We would love to help you strategize your home buying needs. We can connect you with agents all across the US or we can help you ourselves. So please don't hesitate to reach out and we'll see you in the next video.